Hi, this is Acme with the Bulletin Board Heroes here at Vox Markets for Tuesday, the 29th of March. Starting off with Amte, which we seem to have broken out of that descending price channel, which has been in place since the end of January. So that was done really today with a break of 77 pence. Above that, hoping for a move as high as the 50-day moving average and post-February resistance at £1, hopefully to be seen by the end of next month. This stage only well below 70 pence, really delaying the upside scenario, and really we shouldn't really go back below the 75 pence area, which has been recent support for the shares. Runaway move for the next stock, and really trying to work out how far it's going to go. I know it's probably not the most liquid in town, but here we've got Bisichi, and we had that big breakout from February, breaking, I suppose, the resistance there at 138, and above that we're looking towards not only the old target which we were chasing around 180, which is a sort of 1 year resistance line projection, but also the top of this rising trend channel from last year, if I can try and get it on a larger scale, the top of that channel there, which is currently heading towards as high as £2.20 over the next month or two. So that's something which is well worth following on over the near term. As I said, around the 140, the notional stop loss on that, we've got the 50 and 200-day moving averages rising nicely, so I think we should keep going on that situation. On to another stock which seems to have delivered for the bulls, Chariot. Interesting, we had that gap fill down to the initial, well, the floor of that gap from January, around 7.5 pence. So just filled it and then bounced quite quickly, bounced off the 50-day moving average as well. We hit our old target around 14 pence, and the longer we stay above 14 pence, the greater the chance of a move towards 20 pence at the top of a rising November trend channel. So a little bit like the Bisichi chart there at the moment. I covered Eurasia yesterday, and we're covering it again today because it looks as though the shares are making some inroads in terms of recovery. We've got the old support there around 14, 15 pence. We've also got a gap to fill up at 15.5 pence, and the 50-day moving average around there. It looks as though we're breaking out of this symmetrical triangle that's been in place since basically the end of last month. The level that we'd like to close above is effectively around the 11 pence level, and above that hoping for up to 15.5 over the next 2 to 4 weeks. All the while we've got the support from that uptrend line in the RSI window with a second decent bounce off that, giving us this potential triangle break. Stop loss at the moment back below 9.5, which is that March uptrend line. Onto a stock which hasn't been here for quite a while for obvious reasons, that the shares haven't really done very well, but we've got a sort of a very shallow uptrend line there in the RSI window for Gunsynd from July. Looks like the shares are now just ready to break that line of resistance from way back in April last year, which is rather surprising, and also the 50-day moving average, that's around, the both of them are around 0.77 pence or so. And if we can do that, then looking towards a penny, which is where the shares were as recently as February at the 200-day moving average. So Gunsynd looking a little bit more sprightly than it has in quite some time. Itaconix is next, and another situation where we're hoping that the decline of recent times is about to end. We'd like to see the shares, I suppose, above the 4.7 pence level, but we've already broken above the 50-day moving average at 4.14. And the longer we stay above that, maybe on a weekly close basis, the greater the chance of a snap of that June resistance line and a move towards the 6.5 pence area over the next 4 to 6 weeks. Decent uplift in the RSI window as well, so that does suggest that we are ready to move, and we've also had a triple dip, quadruple dip rather, of the RSI support line in the oscillator window there from back in July, with the last dip being at the beginning of February. Best case scenario here maybe up towards 10 pence, which is the top of that broadening triangle from November, but I think at this stage we're just trying to get through that 4.5, 5 pence area first. There's obviously a big Russia focus in terms of recovery at the moment, and here we've got JP Morgan Russia securities, which is clearly not for the squeamish. But we'd like to see the shares break above £1.48, which was the peak from last week. And end of day close above that, we could have another go at trying to conquer the 200 pence level. Stop loss can't really be any tighter than the 105 area, recent support or today's low. But obviously, given geopolitical situations, we could just gap up or down in a wild way. On to Mobile Tornado, where I think profits have been cited. Here, I suppose it's very early days, but what would be a win here would be to break the early March resistance and the 50-day moving average around 1.35 pence. If we can do that anytime soon, then there's a possibility of opening up a move to 2 to 2.5, which might bring into play that gap down that we had back at the beginning of December. But very early days there. The only real positive on the technicals at the moment, apart from a bit of buying volume, is the way that the shares were very, very oversold, right on zero. So there may be some reaction from current levels to current news. On to Petropavlovsk, which managed to break that line of resistance that we were looking at. That line there around 2.15 pence, and above that we were looking for a return to the 4 pence area, which has basically happened, which is very nice, just in a 24 hours. Next level up, if we can close above the 4.5 pence zone, would be to go up towards that gap down on the daily chart from back in February. That's around 9.5 pence, which obviously would be a massive win, but it would also retest the 50-day moving average. So maybe we can dare to dream of that as a best-case scenario for POGs over the next few weeks, especially while we hold above yesterday's high around 3 pence. Above 3, best-case scenario target, up to 9.5 near term. So we hope that will pan out. Plexus Holdings is next, and here it looks like we're breaking out of this falling wedge, which has been in place since December. The level to break is basically 6 pence on an end-of-day close basis, and if we can do that, we've got 7 pence initially, which was the old December resistance in the 50-day moving average, but maybe more interestingly, we could head back to 8.5 by the end of next month if we can get a decent weekly close above 6 pence later this week. Just a couple of stocks to go now in what was actually been a surprisingly dry day for the bulletin board heroes. Here we've got Primorus Investments, which actually looks as though it's in a kind of saucer formation. We had the gap down, exhaustion gap down, and we've closed that at the beginning of the month. Bit of jiggery-pokery either side of the 50 and 200-day moving averages, but just looks as though Primorus is primed to break 4.2 pence, which is neckline resistance, post-July neckline resistance. And above that, the shares could actually head up towards the 5 pence area, which is 1 year resistance. But it's just that pattern there of the, it's almost like a messy cup and handle that we've got on the daily chart. Finishing off with XL Media. And here we've broken out of the falling wedge that the shares were in. Not quite sure whether we've done that with a gap or not, but yes, I think we have done that with a gap. So that's a very good development, and that suggests that we could go on to fill the late January gap as high as 37 pence over the next 4 to 6 weeks, and perhaps even sooner. The longer we hold above 28 pence and the broken resistance line there, the greater the chance of a move towards the 40 pence region. That's it for me today. More updates tomorrow.